Let's take one more practical question. Before I start practical question, let me remind something again. In trial balance, there are different accounts. All these accounts you find in the trial balance can be categorized into three parts. Number one, nominal accounts. Number two, real accounts. Number three, personal accounts. What are nominal accounts? Means all expenses and losses and all incomes and gains. Do you remember the rule of debit credit? If you look at the table, what was there? Debit all expenses and losses, credit all incomes and gains. This rule is related to nominal account. So if you find any expense, any loss, any income, any gain, plus if you find any purchases or sales, all are nominal accounts. Nominal accounts always go to the trading account or profit and loss account. Then the next is real accounts. If you remember the rule of debit and credit, debit what comes in and credit what goes out. Basically this rule was related to real accounts. Means only real account can be debited and credited as per this rule. So real accounts, what is that? The accounts of assets like cash, building, computer, machinery, furniture, etc. All these accounts are real accounts. Number three, personal accounts. Debit the receiver and credit the giver. This rule was related to personal accounts. Personal accounts means any account of any person, organization, firm or company. They are called personal accounts. The owner is the real person and the firm is the artificial person. So the name of the firm is also a personal account. And when we make final accounts on the basis of trial balance, you must remember three golden rules. Three don'ts. What are the don't? Don't miss the item. Don't repeat the item. Don't change the site. Means don't miss the item means you have to take each and every item of trial balance to final accounts. Don't repeat the item means one item can be taken to final accounts only and only once. It cannot be repeated. Don't change the side means the debit item of trial balance will go to the debit side of final accounts and credit item of trial balance will go to the credit side of final accounts. So this is the trial balance as on 31st March 2013. Whenever we write down trial balance, we have to write down as on. Cash 8,200, opening stock 100, purchases 800, loss by theft 500, loss by fire 200, total 9,800, capital 6,800, sales 3,000, total 9,800, closing stock as on 31st March 2013 rupees 100. So have you noticed anything on the debit side of trial balance? Loss by theft. This is a loss. It is always in the category of indirect expenses. Loss by fire. It is loss. Loss is always taken to the profit and loss account debit side. So first of all, cash. It will be taken to the debit side of balance sheet 8,200. Opening stock. This is the debit item. It will be taken to the debit side of trading account. Purchases 800. This is nominal account. It is lying on the debit side. It will be taken to the debit side of trading account. Loss by theft rupees 500. This is a loss. All losses are taken to profit and loss account debit side. So to loss by theft rupees 500. Loss by fire rupees 200. It's a loss. It's lying on the debit side. This debit item will be taken to the debit side of profit and loss account. So to loss by fire rupees 200. Now capital 6,800. It will be taken to the balance sheet in the inner column Sales, this is the credit item, it will go to the credit side of trading account. So buy sales rupees 3000. Closing stock rupees 100. This is not included in the trial balance, so it will hit 2 times, means double effect. First of all, it will be taken on the credit side of trading account, then it will be taken to the debit side of balance sheet. If you take any item which is not included in the totals of trial balance, it will be having double effect, one debit and one credit. So let's prepare trading account for the year ending. Whenever you write trading account, you should write down trading account for the year ended. So total 3100 on credit side, and on debit side the gross profit will be 2200. So no need to write down any direct expenses because there was no direct expense. So we have found gross profit of 2200. It will be taken to the credit of profit and loss account. So profit and loss account for the year ending 31st March 2013. So the total on debit side is only rupees 700. So we have to supply 1500 to the debit side because debit side is weaker. So it will be to net profit. Now the total on both sides 2200. Now balance sheet as on. On the liability side, capital is 6800 plus net profit 1500. It will be taken from profit and loss account, and in the outer column it will be 8300. So total on both sides 8300. Whenever you write down balance sheet, you should write down balance sheet as on 31st March 2013.